Consumers are showing signs of increased positivity despite concerns about inflation and borrowing costs. The preliminary University of Michigan June Consumer Sentiment Report surpassed analysts' expectations, coming in at about 63.9 compared to the May figure of 59.2. We are seeing some consumer discretionary stocks perform relatively well lately, and auto and airline manufacturing ramp up production alongside increased consumer confidence. This improved sentiment may be attributed to the resolution of the debt ceiling debate or a better outlook on inflation expectations. The Consumer Price Index, CPI, which measures inflation, has been trending lower on a year-over-year basis, but it does remain elevated from years past. Shelter costs, a large component of the index, make up about 34% of the index and have been a persistent driver of overall CPI inflation because prices remain elevated. This is in part due to a national home shortage. In the housing market, mortgage rates for a 30-year fixed-rate loan are around 6.67% today compared to 5.81% 1 year ago for well-qualified buyers. These increased rates on new mortgages have affected the average monthly payment for home buyers, which has increased by approximately 10% compared to a year ago. Buyers have had to adjust to this new higher rate environment, all while available homes for sale have declined. Rates are high and supply is low. We're on track for the fewest annual number of homes sold since 2012. With many home buyers happily locked into mortgages with interest rates sub 4%, we believe it's keeping some of the supply of homes off the market. All this expected home demand is finding its way to builders. New home starts are up about 6% from a year ago. So what does this mean looking ahead? Well, consumers broadly are feeling better, however, we are measuring off a low point. Consumer sentiment hit bottom about a year ago. This was the lowest measure of sentiment since the index was established in the 1950s. Importantly, from an investing standpoint, sentiment can be a contrarian indicator, meaning when it's at its lows, stock markets tend to perform well going forward. A key to remember during periods of high uncertainty.